Chunkers 101, Step 5, Control with a contract. All real estate transactions start with a sales contract between a buyer and a seller, or a purchase and sales agreement. I have a one-page simple contract that I use. It's going to be up to you and your market, your state, what contract that you use, but I use a one-page contract because it's not as intimidating as the normal 8 to 15-page realtor's contract. That's going to be up to you on what contract that you use. You can go directly to a real estate attorney. When I say a real estate attorney, that's all that they do is real estate. They'll probably actually just give you a contract if you let them know that you're going to do business with them, that you can use it. And that contract, I'm sure, if the real estate attorney is using it, it has stood the test of time for your state. But you can also use the general contract that realtors use that has also stood the test of time for your state. As I said, I only use a one-page contract in my market. It has worked well for me. But explaining how the contract process goes, whenever you're filling out your contract, normally obviously you're going to put the seller, this is for the seller, I'm going to go over the investor's contract in a moment. But for the seller, obviously you'll put the seller's name, then your name or your business name that you're using, either or your name or the business. It's going to be up to you on how you want to do that. I normally will write the address in, of course, with the city, state, county, and the zip code. From there, buyer, I'll also, as the buyer, put in property sold as is. From there, I'll initially write the amount of earnest money that I'm going to give. The earnest money that I normally give is only either $1 to $10. Just depends on what I have in my pocket. Most sellers won't have a problem with that at all. $500 or whatever the amount in your area is going for, what realtors are using, is not, I guess you would say, something legally you have to do. Is just the standard. Now, you will have some sellers that want you to give more money up front as the earnest money. What I always tell them, which is, this is so, and after you do the business long enough, you'll see what I mean, is that I'm not going to give you $500. I'll put it in escrow. I won't give you $100. I'll put it in escrow. Because even though a seller says they own the property, you don't know that they own the property until you pull the title on this property through a title company. Because they may have not bought the property correctly. You'll be surprised on the number of people think that they can just do a quick claim deed and they own it, but they never pulled a title to see if that person actually owned it. So there are a lot of issues that you could, or problems that could arise if you, once you pull the title. So therefore, $1 to $10, I can afford to lose that. Maybe even $50, I can afford to lose that. But once it gets around $100, I really want my money back, and it may be difficult for you to get it back. But most of the sellers that I said, they won't have a problem with you giving them that. You just need to show some type of consideration to bind your agreement. You can actually give a penny. It just has to be some form of consideration. Whenever you're filling out your contract, you want to put your purchase price obviously in and the date you're going to close. As I said, the contract issue, I can't get into that too much because people will buy this course from all over the country, and each state is different. Your real estate attorney will help you with that. As I said, I do offer my mentorship where you can call me and I'll give you advice on what to do and how to try to find these types of attorneys. But whenever you're filling out your contract, this is very important. And I'm just going to get away from the legal side of the contract and just explain to you why the contract is important in this process, because this is how you're going to get paid. But once you put a property on the contract, legally, that seller can't sell the property to anyone else but you. So whatever time frame you all set, I normally do 30 days. You do as many days as you can get, 45, 60, whatever. But I normally do 30 days. I can close the deal normally within a couple of weeks, but I try to give myself more than enough time. But within that 30 days I have the contract for, the seller legally can't sell that property to someone. I didn't say that they can't do it. They legally are not supposed to, because the contract is binding for that period of time. They have to give me an opportunity to close on the property. Now, if they want to go behind your back and sell it to someone else, that's fine. That's what they have court of laws for, and you can sue for your loss. You know, whatever I guess, and that'll be determined by a judge or jury on what they think you lost out of this deal, but you would win this case. There's no doubt about that, because they went behind your back and sold a property that you had a contract for. But the contract will allow you to control this property for that 30-day time frame, or whatever time frame you all agreed upon. So in that same time frame, if someone else, which is your investor, comes along and wants to pay you more than what you have your contract for, you can do that every day of the year that an office is open, and they'll allow you to close. So just as an example, if you have a property under contract for $20,000 and your investor wants to pay you $25,000 for this house, whenever you all go to close, you have a contract between you and the seller and you and the investor. The investor will bring all the cash to the close. He would even include the closing costs in most cases. Sometimes they'll want you to pay some of the closing, maybe even all of it. It's going to be up to you whether you're going to agree to that. But sometimes they will want you to pay all of the closing costs. But it's rare. Most of them understand that they have to pay closing because they're getting such a good deal anyway. So whenever they come to closing, the investor will have the money to buy the property and the closing costs to close this deal. So the seller will get their $20,000 minus, and you always want to write this on your contract, any unpaid taxes, mortgages or liens. They'll get the difference between that and their $20,000, and you'll get the difference between the $25,000 and the $20,000 that you negotiated with the seller. So basically, you'll walk away with $5,000 on a transaction of that type. When you show up to closing, the seller and the buyer is probably going to be the first time they've ever seen each other. You introduce each other. You introduce the seller to your investor. Hey, this is Bill, the investor. This is my partner on this deal, which he is on that deal. Everybody sits down. The seller and your investor will sign the necessary documents, the transfer deed, and so on. The closing attorney or the closing agent at the title company will pull out the checks, slide the seller a check for $20,000 or whatever that amount will be after mortgages, liens, or taxes are paid out of it, and they'll slide you a check for your $5,000. Everybody shakes hands, walk away, deal done. It's that simple. Repeat that process over and over again. That's Control with the Contract. This is Tyrone Taylor, Junkers101.com. I offer my mentorship for $497. That's $497. You can call me directly whenever you want additional help at 205-601-0973. Once we get started in the mentorship, I'm going to walk you through your first 3 deals. Thank you. Step 6 is coming, which is the last step. After that, you should be ready to wholesale houses. Thank you.